Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. It's Friday, and we're together with our listeners again. I always look forward to it.
And we like to start off the show with listener questions. Our first one comes from Justin in Berkeley. Justin's question: Will Dudley, former Fed president, mentioned that if U.S. stocks do not go down, the Fed must make them do so. In lieu of this absurd global bubble in all asset crashes, is the Federal Reserve in a pickle where they are the real or perceived culprits of 8% inflation across the board, or they create the mother of all deflationary crashes in all asset classes? Can the Fed even make stocks cheaper with flight to safety from other countries? Is it even a good idea if implementable?
Yep. Actually, Justin, it's a very timely question because I had just a few months ago looked it up on an article about Fed policies during the 1920s. And that was, in 1920, a great, huge global speculation in commodities ended. It drove the U.S. CPI inflation up to plus 24%, and people are agitated about 8% now. And then it crashed in 1921 to minus 16%, and the Fed then became very defensive about prices, and the Fed was easier than they should have been during the 1920s, not understanding that a great financial mania was on, and when it concludes, as in the past, all asset prices deflate. So here we are, the Fed is doing the same thing over the most of the last decade. You know, the line has been, they got to keep inflation above 2% or something awful will happen. Then what has happened, as in 1929, you get the final boom, business boom of a great financial bubble. Commodity prices go up, and then general prices have risen. But it's still a financial mania, and when it's over, everything deflates. Now, here's another point here, is that I did look up just a few months ago, and in early 1929, some within the Fed wanted to raise the interest rates then in order to cool the stock speculation, and but they couldn't get a majority on that view until August, when they did raise rates. So yeah, I see tremendous excesses in the financial markets, but this has happened before, and the idea of the Fed knocking stocks down is also in another question. But can the Fed even make stocks cheaper with the flight to safety from other countries? No. The former Fed president may be concerned about reckless financial speculation, but my view is that in any great boom, short rates go up like Treasury bills, and they have gone up as the boom completes, and so the Fed is just following the natural rise in short-dated market rates of interest, such as Treasury bills, as the speculation soars. So while the markets are wild, I don't see anything terribly unusual. And it's on path for a post-bubble contraction. Justin, thanks for your question.
We have another question from our frequent listener, Lauren. And Lauren asks Bob, we greatly enjoy your interviews. Your regular guest, Bob Hoye, is a favorite of ours, from whom we have learned much. We have 2 questions for him related to commodities and gold. Our first question, historically, most commodity prices head down sharply in a post-bubble contraction. However, the post-bubble contraction that might come soon is unusual in having been preceded by a huge exogenous inflationary impulse. Boy, those are big words for me to read.
Exogenous, yeah.
Exogenous? See, I didn't even know how to pronounce it.
That sounds like something romantic.
Exogenous.
Yeah.
Well, see, and I called it exogenous. Might we experience a stagflationary contraction in which inflation-sensitive assets, such as many commodities, do not decline in price much or at all, even as demand falls? So, Bob, are we into stagflation, and maybe define what stagflation is for people who may not have experienced it like we have?
Yeah. Well, the 1970s was one of those natural decades where all the speculative activity went into commodities, and you had soaring commodities, soaring wholesale prices, and eventually called it the producer price index, and then inflation went up to 14%. And the economists had theories that if you inflate the economy, you're going to get better economic growth. And then they discovered that wasn't happened. So you had inflation with a not strong economy eventually. So then they called it stagflation. And a large part of the research community fully understands that the Fed is evil and it's going to depreciate the currency because they think it makes the economy go, and then you end up with price inflation. But they've not done enough research to understand that you get a decade where the Fed is very easy and the inflation is in stocks and bond prices, which is, they still haven't figured it out. But at any rate, the bubble, the financial bubble, is the key item here. But because, and now it often ends, the previous bubbles have ended with a thrust in business and a rise in basic commodities. Where this has now been really exaggerated because you had the COVID shutdown, which shut down a whole lot of things. And then you had the war in Ukraine, which is going to disrupt agricultural prices and stuff like that. And then plus you had this extraordinary squeeze in nickel. So what you've got here is that reminds of 1873, which was a great financial bubble. And in London, one of the senior merchant banks was Baring Brothers. And with that 1873 bubble, there was some operators going on in copper, and there was a hell of a squeeze. And somehow Baring got involved in providing some liquidity and helping out with the copper problem, and I think they may have got stuck with a lot of copper in a post-bubble contraction. And then the other one was that, of course, in a post-bubble contraction, lower-grade bonds go all to hell. And this is, I think, was Argentinian or Peruvian bonds that that Barings were also involved with, so such that one of the great merchant banks in London in 1890 failed due to a long-running problem in copper and a long-running post-bubble deflation in low-grade bonds. So I think that stagflation was the event of the 1970s, and that the major event is financial speculation. And after every great financial bubble since the first in 1720 has always been followed by a post-bubble contraction whereby most asset prices go down. Now, question 2.
Bob has told us that the real price of gold increases in a post-bubble contraction when the increased profits of gold miners underpin the rise in gold mining shares. However, energy is a major cost to gold miners. Could the cost of energy remain high for reasons outlined in question 1 above, such that the profits of gold miners are eroded and so is appreciation of their shares?
Good question. However, the only answer is to look back in history. And with the real price of gold going up, no, let's start one step back. With the real price of gold going down in the final stages of a financial bubble, the cost of mining go up. Copper goes up, energy costs go up, and then when the bubble is over, those costs go down. Now, some 30% of the cost of mining are energy, one way or another, either to turn the wheels or by way of explosive blasting agents and stuff like that. So, no, it's going to work out the same way that... the other thing is that, of course, with the final stages of a stock bubble, as I said, gold shares underperform. And yesterday's piece, we reviewed the Standard & Poor's. No, we took the GDXJ and divided it by the S&P. And since July 2020, gold stocks relative to the S&P have been way down. And this is the way it's supposed to work. So, but for the last few months, gold's real price, which had declined on schedule, has been stabilizing but not yet turned to a rally. And the same thing with gold stocks, where they've been underperforming the S&P and appear to be stabilizing but are not yet in an uptrend. So this is why we're looking for somewhere, perhaps in the fall, the crisis that is spreading through the rest of the world can hit New York, and the big market will sell off and provide another opportunity in gold mining stocks. Now, but the irony is that in order to set up gold's real price to its uptrend, is you need a credit crisis and weaker prices. So that's what we're looking for, and there will be a terrific buying opportunity, because then you go into a multi-year bull market for gold's real price and for the gold stocks from major mining companies right down to exploration juniors. And I want to tell you guys, I'm really looking forward to it.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, some of the headlines that caught your eye today. Trucker stocks plunge as freight recession looms. I thought there was a trucker shortage and freight prices were booming.
Well, yeah, and there's been a shortage of truck drivers and stuff like that, but all of a sudden a measure of their activity is got hit. And also I looked at the transportation index, and it also got hit, but not kind of breaking to new lows. So, but I take it as a heads up for the main reason is that the advanced decline line for the stock market reached its best in November and has seriously broken down. The New York Stock Exchange Composite Index, which is a nice broad index, set its high in January and has had a couple of lower highs since, but not broken down. So, and the interest, Jim, I have is not sadistic, looking for a recession. It's that in the past, the moment, so to speak, that the bubble is over, so is the economy. For example, in 1929, the stock market peaked in September, and the economy peaked in August. And back to the 1873 bubble, and believe it or not, the National Bureau of Economic Research did reconstruct the business cycle then, and the stock market in New York peaked in that September, which is ominous, and the recession started in October. So this is where the interest I have now is looking at the trucking index or the transports is because you want to see if there are signs of a sudden slowing in business activity as the stock market has been hit. So, worth watching.
Well, Bob, I recall the last time we went into an economic downturn, you said transports are key because they often predict recession.
Yeah, well, there's the old Dow theory whereby in a bull market, the industrials will go up, and on each rally, the transportation index will make new highs as well and confirm the bull market. And then when it reverses to the point where you can get the Dow making new highs, but the transport's not, that begins to set up a warning on. I think the Dow theory goes back to 1895. So it's an old, let's call it a technical tool. And it's the transports are not doing well, but there's not been a breakdown, so there's no urgency from the transports. All I'm doing is looking for a sign of weakness that could be accompanying the weakness in the stock markets.
Now, do we have an inverted yield curve? Because I've noticed long-term interest rates are now higher than short-term rates.
Well, actually, Jim, we want to be careful with the yield curve, is because in a boom, short rates rise faster than long rates, and that then is what they call an inverted yield curve. Now, we've got the yield curve in the U.S. sort of like from 6 months out to 20 years, back to 1858, which is quite an accomplishment. And the rule of thumb on a yield curve inversion, it happens with a boom, and once the curve inverts, it kind of is a climax thing, and it's the reversal to then to go in the other way, which is called steepening. And in 1873 Great Bubble, the yield curve inverted twice, and in the 1929 bubble, the yield curve inverted twice. And at the moment, there has been portions of the curve inverted. There's nothing the Fed can do about that. It has offered its warning. It could back off for a bit. And as an old researcher, I'd be pleased if it did the double inversion. And so on the next inversion, one can say, okay, this is looking like 1929. So it's going to be fascinating.
Headline, ISM Manufacturing Survey unexpectedly slumps. What does that mean?
Yeah, the manufacturing survey slipped to below 50, and that is a sign of things slowing down. So again, it's a fairly important economic indicator, and it turned down. So apparently it was the down to the lowest in 18 months on the ISM Manufacturing Survey. So it's worth noting.
Mm-hmm. Headline, how to get through Putin's propaganda iron wall. How do people in Russia get to find out the truth about what's happening in Ukraine?
Well, they've got to clamp down on media, and also I think I read a headline a few weeks ago that thousands have been street protesters have been apprehended and put away. And then I saw one just the other day about, here it was, Wall Street Journal, April 6th. We will kill you. How Russia silences its anti-war movement. So they're trying to keep it all positive at home, but I saw some numbers here this morning that in their 1980 invasion into Afghanistan, there was something like 14,000 bodies sent home in body bags. And then the public got fed up with it, and you had the popular uprising in November 1989 that took down the Berlin Wall, which was the end of many communist governments. So what you have now of numbers, they're all over the place, but it seems that the Russians have something like 17 or 18,000 casualties in 40 days of war, whereas the 12 or 14,000 casualties in Afghanistan were over a number of years. So there's going to be a shock hit ordinary folk in Russia, and it could prompt another popular uprising. And I think it's quite possible because What Putin is doing is extremely reckless, and but at least it's coming out where there is a popular support around the world for Ukraine and its stand against Russia. And Russia is, if you read the stories, has been resorting to terrorist moves and blasting a train station where ordinary people are, and hitting, who knows whether it's accidental or not, but hospitals and things like that. So atrocities are being committed by the Russians in Ukraine, and the trick now is how to end it, and we'll watch that for sure. But in the meantime, it sure put a huge squeeze on in metal prices and wheat. But I'm going to say, Jim, that we look at the CRB index, which is an old and long-running index of basic commodities. And everybody piled in, and we were also, in January, we were looking for industrial commodities to rally out until around March, and then you had this extraordinary news, and so, but on the CRB, the technicals became as overbought as at the cyclical peaks in 2008 and 2011. So we're looking at this, and a lot of the play is in the market, and so the rest is just letting market forces unwind themselves on these extraordinary squeezes. And we also note that copper can do a secondary rally out to July. Lumber can rally into June, and then copper and lumber can have lows in the fall, and sometimes you can have low, even serious lows for crude oil in January, February. So after mid-year, we might be looking at the old thing about sell in May and go away, and this would be a sell in May and go away and hide for sure. So it'll be fascinating to watch, Jim. J.P.
Morgan is reviewing commodity exposure after the nickel chaos.
Yeah. Somehow Morgan was involved, and I don't know exact details yet, but it reminds a little of my story about Baring Brothers in London following the 1873 mania, and it took them to 1890 before they went bankrupt on the disasters that were committed in 1873. So, hey, we've got lots of patience here, Jim.
Well, I think the nickel crisis was caused by a Chinese billionaire trying to corner the market, much in the same way that the Hunt brothers tried to corner silver back in the late 70s.
Oh, yeah. Yeah, you had that. That attempted corner on silver was very exciting and very dramatic and very persuasive, and it went until just all of a sudden it blew out, and it was over. I think it was September 21st of 1980 when that completed. And then down it went. So, these are fascinating times.
And journalist Terry Reith in Edmonton, Alberta, has dug up this story. President Joe Biden is trying to get more Canadian oil, but he refuses to revive the XL pipeline, which he canceled in his first day of office. So politically, he's in a tough place because he promised all of his buddies that he cancel pipelines. But America needs oil if he wants to bring down gasoline prices.
Yep. They're absolutely mad, pleading with Iran, which has technical difficulties in increasing production, and then hoping to get product from Venezuela, where the socialists have run one of the best oil reserves in the world into nothing. And yet they won't turn loose the oil people in U.S. And of course, Trudeau in Canada is making some positive noises, but hey, they hate oil and gas. Not only hate it, but they fear it because of some strange superstition about carbon dioxide and climate. But so no, the midterm elections in the U.S. occur on November the 8th, and a lot of Marxist socialists are going to be forced out of office, and then that can set up a tremendous reform movement in order to get common sense back into action. Hey, Jim, there's going to be a new bull market in common sense. How about that?
Joe Biden asked China to increase its oil production, and everybody will go, what, China oil? China produces nearly 5 million barrels of oil a day. It's ranked 4th in the world in oil production, but you don't hear about it because they consume all the oil they produce, and then they import a load of oil because they don't produce enough. So with Biden calling on China to produce more oil to help bring down his own gasoline prices, when you have Canada, who has boundless oil and natural gas, is right next door, but he cut off the main way to ship it, the most efficient and cheapest way to do it, which is a pipeline. And Bob, and when it comes to moving oil, the safest ways, moving it by truck is the least safest.
Yep.
Then rail, then ship, then pipeline.
Yep.
So, in other words, this encourages the most dangerous way to transport an explosive product when pipelines are the safest.
Yep, and we know that there's been a lot of Russian money being pumped into the Western world condemning oil and gas pipelines and oil and gas production.
Yeah.
And
most of
even Obama, when he was in office, said that under my plan of cap and trade, the price of gasoline by necessity will go up. And this is, of course, what part of the drive was with Biden's first step to shut down where he could oil and gas production and transportation. They are absolutely mad, Jim.
Friend of the show, Joseph Schachter, points out, and we discussed it in our interview on Thursday, Churchill, Manitoba has become virtually an ice-free port thanks to climate change. And I've seen several studies that say no country will benefit more than Canada from climate change. And yet no country is spending more on stopping it than Canada. So it's kind of illogical. But anyway, so if Quebec and Ontario and the Maritime provinces don't want Alberta, Saskatchewan, and BC gas and oil, why not just build a pipeline to Churchill, Manitoba, and ship it to Europe? Because if they could, and now they've learned their lesson, Russia is not a reliable supplier of energy. And frankly, you don't want to buy their energy products because it's just financing a war machine.
Oh, yeah, because Putin's major moves have occurred when oil prices are high, and his oil revenues are also high, because you got to have either gold or senior currency units in order to prosecute a war. Mm-hmm. So I wrote a piece on that a month ago.
Yeah, apparently,
his aggressive moves have occurred with high oil prices.
Yes, apparently right now Europe is giving Ukraine $1 billion a day or a month or something to help prosecute or defend their country, while at the same time giving $30 billion to Putin for his oil and gas.
Yeah, I know. Jim, there's a lot of madness out there, but I'm going to stick with my forecast that with the November election in the U.S., it'll mark the beginning of a new bull market in common sense.
Bob, thank you so much for chatting.
Jim, good to be with you, and look forward to next week.
As you heard, Bob loves to answer your questions. You can send your questions to us to info@HoweStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.